Good afternoon everyone. Today our group will be presenting 3 case study. The first one is Nike cost of capital. The second one is JetBlue Airways IPO valuation. The third one is American Greetings. Our group members consist of myself, PREMAH, Hakel, ARUN, KUMAR and VIKNESWAREE. Let's move on to the first case study, which is Nike cost of capital. Kimi Ford, a portfolio manager from North Point Group, waiting whether to buy Nike's stock. Nike's revenue, net income and market share have fallen drastically between year 1997 and 2000. In order to boost revenue, Nike would increase exposure in mid-price footwear and apparel lines. Kimi Ford and her assistant, Johanna Cohen, carried out own analysis to get a better picture on Nike's share price. Let's move on to the first question. What is weighted average cost of capital? Weighted average cost of capital is the rate of return required by a capital provider in exchange for foregoing an investment in another project. It is important for a company to decide on capital budgeting, to design the company's financial structure and to decide on the method of financing. Let's move on to the second question. Do you agree with Johanna Cohen's WACC calculation? Why or why not? Johanna has used single cost of capital in calculating WACC. We agree with the use of single cost of capital because Nike's business segment, both footwear, apparel and equipment, have same risk. So a single cost of capital is sufficient for the analysis. Johanna has used historical data in calculating cost of debt. We do not agree with the use of historical data in estimating the cost of debt, and we calculated the current cost of debt is 7.16%. After tax cost of debt is 4.44%. Based on Johanna's calculation, the cost of equity is 10.5%. She has used risk-free rate comes from 20-year T-bond rate, which is 5.74%, average beta from 1996 to July 2001, which is 0.8, geometric mean of market risk premium, which is 5.9%. We agree with Johanna with the use of 5.74% as a risk-free rate because cost of equity used to discount cash flows of long run, so rate of return of T-bond with 20 years maturity can be used to calculate the cost of equity. But we do not agree with Johanna uses on the average beta from 1996 to July 2001, which is 0.8, because we need to find a beta that is most representative to future beta. So we suggest using the most recent beta estimate, which is 0.69. And we agree with the use of geometric mean of market risk premium of 5.9%. So our estimate of cost of equity will be 9.81%. We do not agree with Johanna to use book values as the basis for debt and equity weights. Market value should be used in calculating weight. So our calculation of WACC is 9.27%. Let's move on to the third question. Calculate the cost of equity using CAPM and this dividend discounted model. So the cost of equity using CAPM is 9.81%. The cost of equity using dividend discounted model is 6.7%. Let's move on to the advantages and disadvantages of CAPM and dividend discounted model. Advantages of CAPM is it is more realistic since it considers only systematic risk and more theoretically derived relation between risk and market premium. The disadvantages of CAPM is it's difficult to calculate beta for all projects. People sometimes focus on market risk to exclusion of corporate risk and make mistake. The advantages of dividend discounted model is good flexibility when estimating future dividend stream, provide value appreciation even when the inputs are overly simplified, avoids force-fit assumptions into the model, allows sensitivity testing and analyzing market reactions to changing circumstances. The disadvantages of dividend discounted model is it is subjective. Inputs can result in misspecified models and bad result. Are sensitive to small changes in inputs. This end my parts. Hakel will continue with the next question.
Hi, good evening. My name is Hakel and I'm be discussing on the last question, which is what should Kimmy Ford, the portfolio manager, recommend regarding on the investment of Nike. So to discount the cash flow based on Exhibit 2 with the new calculated WACC of 9.27%, the present value equals to of the share price is like $58.13 per share, which is more than the current market price of 42.09. So since the IV is actually more than the current market price, you can say that the stock can be considered as undervalued. So because Nike is selling for less than what it's worth, and it can likely to rise, and the value will likely rise over time, so my recommendation for Nike is to buy. Moving on to the second case study, which is JetBlue. JetBlue was a low-cost airline which started out in 1999, and they aimed to fix everything that sucked about airlines. So they offered maybe live TV, better seats, and stuff like that. So after 2 years of operation in 2001, they decided they wanted to raise capital through IPO. So through their roadshow, they actually got to set the share price to from $22 to $24 with 5.5 million shares. But after that, the management filed to increase the offer price to 25 to 26 because they expect a better demand from investors. So the problem statement is, should JetBlue stick to their discounted IPO price listing of 22 to 24 or actually increase to 25 to $26 per share in order to address investor demand? So speaking of how to raise capital, so JetBlue actually made an IPO. So the advantage of going public, which being they will get financial benefit, which is the capital raised from the equity offering, and also increase in public awareness, because this will actually go in newspapers saying that JetBlue actually made IPO, so anybody can actually have ownership in JetBlue, because some people really like this low-cost airlines before 2001, the 9/11 attack, of course. So another advantage would be they have increase in liquidity due to the capital gain. And the disadvantage would be because they're actually listing under one of the stock exchanges, so they actually have the need for added financial disclosures, and with that comes extra costs, and also they will get extra added pressure from the society at large, because of course they want to pay dividends in order to please the investors, so they would rather sometimes focus on short-term goals instead of long-term goals. Another disadvantage would be that in a way that they will have less controls in decisions, because their decisions will actually need to benefit their stakeholders and shareholders in a whole. So the next question would be the approaches in how to evaluate JetBlue. So the first one would be a discounted cash flow method, which is a forecasting of future cash flows based on expected revenue growth. The forecasted future cash flow will actually be translated into present value using the discounted rate, which will be calculated using the WACC formula. So, and then once you get the NPV, just divide with a number of outstanding shares and you get the intrinsic value of the company, of the share, of course. So the second method would be comparables, where we compare similar companies with similar in nature, maybe low-cost airline companies who actually made an IPO listing recently, and to see compare the prices before listing and after listing, prior to the listing date, of course. So the third ones would be multiples, where you use ratios to calculate the calculate by dividing the market value with any specific item in the financial statement. So you can actually use PE ratio, PB ratio. This commonly used by Warren Buffett, of course. So, but for the sake of this case study, we'll be using the discounted cash flow method, and we'll be calculating the new WACC. So presenting next will be my team member ARUN. So enjoy.
Hi, Dr. Puan. So I'll be presenting on JetBlue case study for the part 3, 4 and 5. So before that, my name is ARUN Kumar. So let's move to the question part for the part 3. So is the financial forecast reasonable, and what are the assumptions used for the forecast? So basically, based on our analysis, we find that the financial forecast stated in Exhibit 13 is quite reasonable because they are comparing with other airlines in the industry, in the same industry, and particularly they are comparing with Southwest Airlines, which are very similar to JetBlue Airlines operation, and in terms of their performance are quite similar. So and their revenue growth is quite reasonable and constant throughout the years. So that's why we find that the financial forecast is quite reasonable. So basically, the assumption that they use for this financial forecast is the revenue growth rate fixed at 4% every year. That's the first one, the number one of assumption. And the operating margin is also remain constant at 15.2% from year 2003 onwards. It's not 2013 actually, 2003 onwards. And the depreciation per aircraft increases by 100,000 million for every 3 years. So that is one of the assumptions. I will notice every 3 years there is an increase. The tax rate is fixed at 34%. The capital expenditure increases by 5% every year, and the net working capital constant at 9.4% every year. So basically, these are the assumptions that we notice during what we analyze in the case study. Next is what discount rate is appropriate for the cash flow forecast, and we need to provide some justification on that. So based on our analysis here on the case study, the discount rate is basically we are using the weighted average cost of capital formula, or WCC. So in order to use that formula, we need to identify the cost of equity, the weightage for equity, the cost of debt, as well as the weightage for the debt. So all this information are available for Southwest Airlines. So we are using Southwest Airlines as basis to calculate for JetBlue Airlines. So the information available for Southwest Airline here is for the cost of equity. The risk-free rate is 5%. The risk premium rate is 5%. The beta is about 1.1. So the cost of equity is 10.5% based on the formula we use. So the formula we use for cost of equity is the CAPM model. By using that, we get cost of equity is 10.5%. For cost of debt, the yield to maturity based on the bond is 8.68% for Southwest Airline. So this is prior to tax, before tax. So cost of debt after tax is actually 5.34% using the tax rate of 34%. The total equity value for Southwest Airline is basically the current share price of 20.69 cents per share times with total outstanding shares of 776 million. So we get about 16,072 million equity value, and the debt value, total debt value, is 1,842 million. And total debt and equity value, we have to total up both the equity as well as the debt value, which we get $17,914 million. So with this, we can identify, or we can calculate the weightage for equity as well as for debt. So we can see that the weightage for equity is 89.72%, and the weightage for debt is 10.28%. So by using all this information, we can calculate the cost of capital of WCC, which is about 9.97%. So this is basically will be the discount rate for JetBlue Airlines. So we can see here all the information is summarized in this table. So and at the end we get the cost of capital, or the discount rate, is 9.97%. So at what price will you recommend that JetBlue offers its shares? And we need to provide some justification. So basically we are using discounted cash flow method to calculate the share price for JetBlue Airlines, with the growth rate is fixed at 4%, and the discount rate is 9.97%, as what we calculated earlier for WACC. So with this we can determine the free cash flow from the financial forecast that is available. So with the financial cash flow, we will discount that using the discount factor of 9.97% every year. Then we get a net the present value for the free cash flow each year, and the net present value for free cash flow from 2002 to 2010 is negative 674 million. The terminal value is 3,937 million. Basically, we calculate using the final year's free cash flow, and the present value for the terminal value is 1,674 million. With that, we managed to get the equity value, and finally, the implied share price that we obtained is $28.48 per share. So basically, this is the detailed calculation from the financial statement, the forecasted financial statement that is available. Then using that, we calculate the free cash flow. Before we arrive to free cash flow, we use from the NOPAT, we add up the depreciation and we minus the capital expenditure and also the changes in net working capital. So we arrive to the free cash flow. So we can see there the discount rate is used 9.97%. So we can see the discount factor for each year. Then we manage to get a present value. So the net present value is negative 674 million. Then the terminal value is basically from the final year, the last year 2010 terminal value, and then the present value for the terminal value you can see there. So from there we can determine or calculate the net equity value. So the net equity value is basically we use the present value of the terminal value 1674 million minus the net present value of the free cash flow negative 694 million. So we get net equity value of 1000. So the average number of shares outstanding is 35.1 million shares, and the implied share price is $28.48. So basically our recommendation here is with the share price of 28.48% intrinsic value, it is better for JetBlue Airlines management to offer or to fix the offer price for the IPO listing below $25 which is much better for them, or is less risky for them. If let's say they decide to go beyond that price or beyond $25, so they may they might be exposed to high risk, and they may lose the capital gain they're supposed to get from the listing. After all, their intention is actually to gain some cash or some fund from this IPO listing, so that they can work on their working capital, as well as to spend some money on the capital expenditure for their expansion purpose. So basically, that is our recommendation for them to fix the listing price below $25. Thank you. Okay, next we are moving into new case study. It's on AmericanGreetings, where the issue is mainly on the share repurchase. So basically, when if we look at the summary of the case study, AmericanGreetings actually is one of the largest greeting card publisher in US, with 1.7 billion revenue yearly. So what happened in 2011, the end of 2011, the share price of AmericanGreetings start to drop drastically, where at the end of 2011, the price was only $12.51 per share. So prior to that, the share price for AmericanGreetings used to be above $20 per share, and the sudden drop is very questionable. So what happened is AmericanGreetings, the management decided to go for share buyback worth of 75 million. Option that have been taken to actually to safeguard the company. So besides, they also have some new business strategies to venture into e-greeting cards selling, which is basically on electronic greeting cards. And also they move into other business, such as providing gift wraps, candles, party goods, and other gifts, and also own number of other brands besides their own particular brand. So as we know, the share price declined drastically, and based on what the analysts has identified or analyzed, the future for AmericanGreetings is not it's not positive, and it is on negative sentiment now, based on the analysis for the next 4 years forecasted financial statement. The best case scenario they can arrive is their revenue decline by 4%, and the worst case, it can go up to 16% decline in their revenue growth. So basically, this is what this case study is all about on AmericanGreetings. So now we're going to analyze and see whether the share buyback option is really worth it, or the current share price, current market price of $12.51 is really reflecting the actual view or actual performance of the company or not.
Next, I will continue with case study question for AmericanGreetings. The first question is it 3.5 times multiple is appropriate for AmericanGreetings? And if not, what is the multiple of EBITDA that is justified for AmericanGreetings? I have do the calculation for EBITDA multiple for AmericanGreetings and another 14 comparable firms. And from the table we can see the EBITDA multiple for American Greetings is the second lowest compared to the 14 comparable firms. From the table, we can see that 3.5 times multiple of EBITDA is not appropriate for American Greetings, and we can categorize EBITDA value for American Greetings is in undervalue compared to the average EBITDA value for 14 comparable firms. Average of EBITDA for 14 comparable firms can be calculated by getting the total EBITDA value for 15 firms minus with the American Greetings EBITDA and divide by the 14 comparable firm, then equivalent to 7.48 times. And based on that, we can say that American Greetings EBITDA value must be closer to 5 times. For that, we need to change share price of American Greetings. From the graph given in case study, we can see that most of the share price is above $20 throughout 2010 and 2011. In order to get EBITDA multiple closer to 5, we put an estimation of share price of $23 and all other factors are constant. In order to get EBITDA multiple, first we need to get enterprise value of American Greetings. It can be calculated by share price of $23 times with share outstanding of 38.38, then plus with total debt $235 minus total cash of $86. The enterprise value will be equivalent to $1,030.36, and the EBITDA multiple can be calculated by dividing enterprise value by EBITDA of American Greetings. The EBITDA multiple will be equivalent to 5.05 times. For next question is, what is the share price should be if the multiple of 3.5 times, and what is the implied share price that correspondent to that multiple? For EBITDA multiple of 3.5, we use the same formula, total equity plus total debt minus total cash divided by EBITDA of American Greetings. We put Y as the share price. We can see that share price will be equivalent to $14.74 for multiple of 3.5 times. And for the implied share price, we can see that the EBITDA multiple will be 7.48 times, and put Y as the share price, and we can see that the share price will be equivalent to $35.93. Second question is, what is the estimate of the appropriate discount rate for free cash flow forecast? We can calculate it by using WACC formula. And based on the case study, it's given that pre-tax cost of debt is 58%, and we can calculate cost of debt after tax by 1 minus 40% of tax times with pre-tax cost of 58%, then cost of debt after tax will be equivalent to 3.48%. And for the cost of equity, we can use CAPM model. Is based on the case study, is given that risk-free rate is 2.8% and beta is 1.63 and risk premium is 5%. The cost of equity can be calculated by adding risk-free rate plus multiple of beta and risk premium, and the cost of equity will be equivalent to 10.5%. In order to get weight of equity and debt, first we need to get total of equity, which is $479.38 and total debt of $235. For weight of equity, we can calculate it by total equity divided by sum of total equity and total debt, which be equivalent to 0.67. Weight for debt can be calculated by total debt divided by sum of total debt and total equity, which be equivalent to 0.33. To calculate discount rate through WACC, we need cost of debt times weight for debt plus cost of equity times weight of equity. The discount rate will be equivalent to 8.49%. For continue of question 2 is asking what is the best estimate of the implied enterprise value of American Greetings and the corresponding share price. For this question, I divided the cash flow into 3 scenarios, which is best, average and the worst. For the best case scenario, the growth rate equivalent to 3% in long-term growth. Operating margin is 9%. Tax rate is constant at 40%. Share outstanding constant at 38.50. WACC is constant at 8.49%. Value of firm is represent NPV value of the cash flow. Value of debt is constant at $235. Value of equity can be calculated by minusing value of firm and the value of debt. Stock price can be calculated by dividing value of equity and share outstanding. This is free cash flow of best case scenario. The NPV of this case is equivalent to $1,222.24. Next, we move to average case scenario cash flow. For this case, growth of revenue is constant at 1.5%. Operating margin is 8%. Tax rate is 40%. Share outstanding is 38.50. WACC is 8.49%. Value of firm or NPV equivalent to $1,040.61. Value of debt is 235. Value of equity is $805.61. Stock price is $20.92. This is free cash flow of average case scenario. Next, we move to worst case scenario cash flow. For this, growth of revenue is 0%. Operating margin is 7% but slowly reduced to 6%. Tax rate is 40%. Share outstanding is 38.50. WACC is 8.49%. Value of firm or NPV is equivalent to $735.06. Value of debt is $235. Value of equity is $500.6. Stock price is $12.99. This is free cash flow of worst case scenario. The third question is asking for what are the key drivers of value of in your model. In my model, I use free cash flow forecast, cost of capital using WACC formula, and the last one is determining the terminal value using the real GDP growth rate. For the fourth question is asking about do you recommend repurchasing of the shares. From the 3 case scenario, which is the best, average and the worst, the current market value of American Greetings still is undervalued. In conclusion, repurchase shares with the $75 million is the better alternative for the case study of American Greetings. Thank you.